Hello, I'm Harriet Formby. I run my own fractional CFO practice, below the line finance. I've got a background in kind of financial strategy, 15 years across sort of startup scale-ups and finance transformation in a range of sectors, including sort of private equity, not-for-profit, multinationals. But I spend a lot more of my time these days on sort of tech and more creative sectors typically. And I have a particular focus around sort of mission-driven businesses, but the usual range of things, cash flow difficulties through to growth strategies, from sort of pre-revenue all the way up to quite established businesses. So yeah, really good to be here as ever.
Hi, I'm Andrea L. Richards. I run an accountancy practice called Account Navigator. I've run this practice for the last 23 years. Me and my team specialise in management accounts, and we run a virtual finance office where all our clients basically take over their full account function, run the accounts department, but we specialise in understanding your figures so that you make the right decisions to move your business forward.
Hi, I'm Sophie Wright. I'm a fractional CFO and founder of Wright CFO, which is a firm of fractional CFOs. We've been going for 11 years. We're a team of 9 at the moment and growing. We specialize in tech, creative, media, and not-for-profit businesses. And although we do CFO services, we also have kind of fractional financial controller, and do things like we partner with other businesses that do kind of finance related kind of IT migration, stuff like that. Thanks for having me.
Thank you very much, ladies. Samuel, are you audible now?
Yep. Sorry, guys. Thank you for your patience. My name's Samuel, managing partner of Arthur Hamilton and ScaleUp CFO. I lead a team that supports founders across the UK, Europe, and US and Africa, helping them to scale profitably through financial clarity, cash flow discipline, and better decision making. I specialize in turning fast growth but chaotic business into financially strong, investor-friendly companies. I'm excited to be here. Excited to be here once again with very familiar faces in the panel.
Well, thank you very much for that, Tim. Really appreciate it. Well, you've heard them, everybody. We've got an amazing panel today. They're willing to take questions that you may have on your business finances. I've just realized that I've got the date wrong for our Startup Finances Q&A, so I'll change that image in a second. But the idea is quite simple. We're here to help founders with your business finances. Hopefully, after this session, you would have a better idea of your numbers and some clarity in terms of going forward. Today, you can ask us anything about your early stage finances. There are no wrong questions and there's no need to be shy. You might want to know something about your cash flow, or perhaps budgeting, or maybe profits and loss, or your payroll, taxation, bookkeeping, credit, auditing, VAT, banking, broad issues, projections, forecasting, and all that jazz. Please don't be shy. If you are here on the Microsoft Teams call with us, simply drop your question in the chat. We'll then give you the mic. You introduce yourself and then fire away with your question. If you're on the live streams, whether that's LinkedIn, YouTube, Facebook, or Instagram, please be aware that unfortunately we are unable to monitor your questions live, so you'll need to join us here on Microsoft Teams. Being audio only, it means you can tune in from anywhere via any platform or device. Simply go to our website, startup2scaleup.club. Scroll down a little bit, you'll find today's session, which is Startup Finances Q&A 09. Click join. It's a quick registration on Luma, and there you'll see the link for today's session. Once you've done that, then again, just drop your question in the chat. We'll give you the mic and you can introduce yourself and fire away with your question. Now, if your questions today are not on finances, please save them for the other conversations we run. Mondays it's talent, Tuesdays product and tech, Wednesdays growth, Thursdays fundraising, second Friday of each month it's UK startup law, and third Friday of each month it's UK startup finances. They're all from 12 to 1 p.m. UK time. They're all available on our website, startup2scaleup.club. And we also have a WhatsApp community where you can connect with other founders, of course, investors, operators, and our brilliant panelists and mentors as well. We're now going to go on to some do's and don'ts when it comes to early stage finances. In the meantime, you may either want to make your way here onto Microsoft Teams audio call, or if you're here already, start thinking of your question and start typing it. Ladies, what would you say is one important do and one important don't when it comes to early stage finances? And let's not use the same reasoning or logic for both, please. So maybe if we can start from, let's say, Harriet, Andrea, Sophie, and then Samuel, please.
Sure. Okay. So my do would be to make sure that from the outset you set up some sort of financial system as a priority, and get onto software and engage with an accountant as soon as possible, just to sort at least the basics out so you know where you are. And my don't would be to don't be afraid to ask lots of questions, because especially if you're new to managing business finances, things like this are a brilliant opportunity to ask any and all questions.
My do would be, and I say this every time, is definitely register with an accountant from the very beginning. Important to do that from setting up your business, so that you set up the business correctly with the right share formation and stuff, and decide what legal entity is best for you when you set up the business. My don't is don't listen to Dave down the pub. Yeah, go to a qualified accountant who can actually give you the real facts. Don't listen to Dave.
Oh, poor Dave. Thank you very much, Andrea. Sophie, please.
Hi. My do and my don't are around cash and preserving cash in your business. So my do is to do things that will help you get paid by your clients faster. So that could be whether it's a subscription, get them to pay by direct debit, or you can offer discounts to pay within 5 days instead of or pay the full price in 30 or 50% up front. There's a lot of different things you can do. The idea is to get paid quicker and pay your suppliers slower. And then my don't, another thing to do for just preserving cash is if your business is one that has inventory or stock, there's a fine line. You need stock to be able to sell, but a lot of businesses go under because all their cash is tied up in stock and there's too much. So just carry enough stock that you have to sell, but not too much, so that you can hold some of your cash.
Fantastic. So I'm actually still giggling from Dave at the pub joke. All right. So my first, I'll start with a don't, and it's don't treat your bank account like your personal wallet. I would advise that you pay yourself something consistent, even if it's small, and it keeps the business finances separate. I think it's very important you do that. Most early stage startup companies get into bad habits, and they treat their business bank account like their personal wallet. So something you need to kind of refrain from. And a do is a simple 12-month cash flow forecast in place. Just have it in place for your business. It doesn't need to be fancy. It just needs to be clear view of what's coming in and what's going out, and how long you have or how much cash you have left in the business. Most founders make better decisions the moment they see the numbers in front of them, how much they have in front of them. So those are my do's and my don'ts. Thank you.
Thank you very much, team. I really appreciate that. As we go into some questions, something worth mentioning is that we've had about 290,000 people tune into these sessions in just over 4.5 years. And out of these 6 regular sessions, basically, not just this one on finances. But none of that would have happened without people like Andrea, Sophie, Harriet, and Samuel. So if you would like to drop your LinkedIn URLs in the chat, perhaps, panelist, and maybe just a quick sort of sentence about what is your forte in terms of finances for startups, please feel free to do so. And I'd love to encourage the startups, both the ones that are here live and the ones that listen to the recording. If you click on chat, you'll be able to find those links. So please feel free to follow them on LinkedIn. Now we've got 42 minutes left, so we've only got time for some questions. Therefore, I would appreciate it if you don't leave it for last second to ask your questions. In the meantime, I see Andrew's got a fire alarm going off in the building, so please feel free to do whatever you need to do on that, Andrea. But we'll ask the other panelists. I've put a question in the chat. I'll read it out loud for those of you that are listening via the live streams, whether you're on LinkedIn, YouTube, Facebook, or Instagram. So the question is as follows. So this is about modeling corporation tax for startups with losses. She says they're a green tech startup developing algae-based biofuels. Location Newcastle. And then she goes on to say, the challenge we have is that our company has significant operational losses due to high R&D expenditure, and we're unsure how to model future corporation tax liabilities when profitability will be projected. The situation is that we're a pre-revenue funded mainly by grants and some early stage investors. So again, the question is, as a green tech startup with significant operational losses, how can we integrate future corporation tax liabilities into our financial models whilst factoring in carry forward loss provisions? Also, what UK specific rules, such as allowable offset or losses against future profits and compliance with HMRC loss relief regulations, should we incorporate to ensure accurate projections, tax efficient planning? Oh boy, Jesus. Well, I'm glad I'm not a panelist on this. Shall we start with Sophie, then Harriet, and then Samuel, please?
Hi. So I think some of the others on the panel are going to be more knowledgeable than I am on the specifics, especially if they're practicing accountants. I know you can
Sorry to interrupt, Sophie.
Oh, yeah.
I'm really sorry. Just one thing. If you don't feel like it's your bag, don't worry about saying pass. It's totally fine. You know, we're not meant to know every question thrown at us. So
okay, I was just going to say, I know you can bring forward your losses. So in your first year of profitability, you know, if you've had losses in the previous years, your tax liability is going to be negligible because you can move forward. There is a limit. I don't want to, you know, it might be 4 years or 3. I'm not entirely sure. I think the rest of the panel probably know the rules. but I know you can bring it forward, but I'll leave it at that.
Harriet, it's your turn if you've got anything to. Or Samuel, let's go to Samuel. It's fine. Samuel and then Harriet, please. And Andrea, hopefully you're okay. I see you've logged out, so that's totally fine. So yeah, Samuel and then Harriet, please, if you've got anything to add.
Brilliant. Yeah. This is a classic early stage deep tech problem. So I believe what they're saying, they're burning a lot of R&D. You're miles off for revenue, and you're wondering what to actually do with corporation tax in the model. The first thing I'd advise is treat losses as an asset in your model. So even though you're not paying corporation tax yet, as was previously alluded to, every year you're building trading losses that you can use to shelter future profits. So in the model, I'll have a simple loss and tax schedule that does this each year. What you would do is start with losses brought forward. You can add the current year tax adjustment losses as well. And when you flip into profits, you use those brought forward losses to reduce your corporation tax bill, right? So that's number one thing I do. There's other things you can also do as well. You can build into your build in the key UK losses rule. And at a higher level, basically what it is trading losses can be brought forward and used against future profits. And don't also forget the R&D angle as well, because you're a green tech startup with heavy R&D as well. So while you're making losses, you may be able to claim R&D tax relief or credits, which can either increase your losses or convert some of those losses into cash back from HMRC. Thank you.
Sorry, I think I was muted and then yeah, it's all good. I think all I'd really add to that is just at a high, it's quite a detailed question. At a high level, I'd say yes, there's possible, depending on dates and things, possibility that you'll get a credit back. In terms of sort of two sorts of modelling, I guess. If you're modelling for sort of like viability and general like business trading as you get going, then obviously start to assume that there'll be a corporation tax bill. If you're modelling sort of 5-year models, I'd say do a little calculation, or if you've got tax advisors, something I like to do is just do that little high level kind of corporation tax calculation, but it's different from the sort of P&L model, but just to the side, and just sense check what the position's going to be. But there is going to be different things with dates here. So the dates that we're talking about, the years and the interaction with any changes in legislation around R&D, tax credits and stuff is going to be very important. So getting all the facts out essentially and working through it, I think that's probably what I can add on that one.
Thank you very much for that, Tim. That was amazing. Really appreciate that. Well, we're now going to go into question 2. And just before we actually go into that, I guess just a quick reset of the conversation. I see there's some new people that have joined the live streams. This is Startup Finance's Q&A. It's our 9th monthly session. We run this every 3rd Friday of each month between 12 to 1 p.m., where myself and some amazing panelists who've been there and done it take to the stage to answer any questions you may have about your finances in the UK in terms of your business, that is obviously your startup. There are no wrong questions and there's no need to be shy, as it's a learning curve for us all. You can ask us about anything to do with finances, whether that's cash flow, budgeting, profit and loss, payroll, employee benefits, taxation, bookkeeping, VAT, auditing, tax credits, loans, banking, fraud issues, projections, forecasting, and anything within that sphere, really. If you're on the live streams, there's no point in trying to send me questions because unfortunately we can't monitor any questions live, whether you're on LinkedIn, YouTube, Facebook, or Instagram. So if you do want to ask anything, you'll have to join us here on Microsoft Teams. Quickest way to do that is to go onto our website, startuptoscaleup.club. Again, startuptoscaleup.club. You will need to scroll down a little bit. You'll find today's session, which is Startup Finances Q&A 09. It's a quick register. Once you go there, basically click join, and it's a quick registration on Luma, and there you'll find today's link. Once you do that, simply come here onto our audio only Microsoft Teams call. And being audio only, by the way, means you can tune in from anywhere via any platform or device. Then simply drop your question in the chat. We'll give you the mic. You introduce yourself and then fire away with whatever question you have. Now, without further ado, we'll move on to the second question. That's an interesting one. So this is about allocating overheads across multiple product lines. So they're a health tech startup that work with wearable health monitors and subscription-based analytics. They're based in Exeter, recently started. The challenge is the company struggles to allocate shared overhead costs such as office rent and utilities across its hardware and software offerings. The situation is that their revenue generating seed funded with an expanding customer base. And then the question goes, as a health tech startup with both hardware and subscription-based analytics offerings, how can we accurately allocate shared overhead costs to reflect the true profitability of each product line? What UK-specific cost allocation methods, such as activity-based costing or standard overhead absorption rates, should we implement to ensure compliance with UK GAAP? Maybe one of the financial people and accountancy people here can help me with that. No idea what GAAP is, whilst improving pricing and operational decisions. Maybe we can start with Samuel, then go on to Harriet, and last but not least, Sophie. If you've got any thoughts, please let me know. Maybe somebody can explain for me if you know what that GAAP stands for, please.
Yeah, it's just a standard UK accounting practice that most accountants tend to base their accounting on. But I would address that as well.
Thank you.
But it's a great question. You've got both hardware and software subscriptions, analytics. And I think the mistake is trying to split overheads evenly or guessing. That always distorts profitability of each profit line. The goal is to allocate overheads based on what actually drives the cost, right? So the first thing I do is start with two buckets of cost. You've got your direct cost. This is easy. This is your bills of materials, software hostings, etc. And then you've got your indirect overheads, you know, your rent, utilities, and staff time as well. Now, the direct cost goes straight into the product line, and overheads get allocated using a structured method, right? Now, going to what you said about the UK GAAP, right? Now, there's two methods. Usually you can manage this, and I know I'm speaking fast, it's only for time's sake. So if you get the opportunity to record this or to go back on the recording, please take notes of this and apply it to the business, right? So the first one,
it is recorded and public, so whoever wants to, more than free to go back to the recording. Sorry, Sam.
Fantastic. So the first thing is activity-based costing, right? Some people refer to this as ABC. And this is great for startups with mixed physical and digital products. And what you do, you allocate overheads based on activities. So you've got stuff like engineering hours, customer support time, assembly time, data processing usage, right? And this gives you a very accurate picture of the real cost of supporting each product. The second one is the standard overhead absorption rate, right? And this is more traditional but completely UK GAAP compliant. And you choose a sensible driver, for example, labor hours, machine hour, floor space, number of units produced. Then you calculate an overhead rate, right? It could be X amount per labor hour and apply it consistently. In short, I'm babbling a bit, but in short, use activity-based costings for accuracy and use absorption-based costing for GAAP compliance. Apply both consistently across your products, and you pretty much get a true picture of the profitability across hardware and analytics. I hope that did not go over your head. Contact me on LinkedIn if it did. I can explain this a little bit more to you if it helps. Thank you.
I'm definitely going to go back to this recording. Thank you, Samuel. I think we said Harriet and then Sophie, if I'm not mistaken.
Yeah, that was a really good, quite comprehensive kind of answer there. And I think just a bit I would stress on it is there's a good chance that you've got a very different method into how you allocate things for the management accounts that are used to, plan and to make decisions, and the accounts that you file with Companies House, which are going to be higher level potentially depending on your size, unless if you're sort of obviously not at this stage, but if you're a much bigger company that had published accounts and things, that's going to be quite different. So I think the bit to be aware of at a smaller stage is making sure that it makes sense and you can make decisions from it. And it's definitely look at allocation methods, usage, square footage, etc. If it's salary based, I don't think we've mentioned people, but I think people is going to be a really big element of this, because I'm guessing you employ staff, so I would definitely be looking at that, working out a sort of salary rate, maybe often based on sort of an hourly rate for your staff, and then being able to allocate that. Presumably they may or may not, I don't know if they're like, some people are working on hardware, some people are working on software, how you're set up, or if people are doing both. So you need to make sure that you also allocate that in the same way. And also probably just not getting too into the detail with it. You want it to be really clear so that people can step back and look at the different divisions and understand the profitability. But there's a danger maybe that you get too detailed, so you may still want an element of some overheads that are just the overheads of the business still in a lump at the bottom, and that you don't split down. So I think that it's just getting the right level of detail, that it's really clear what's where the profitability is, but it's that it's fit for purpose for the sort of decision makers. So hopefully that's helpful to add on.
Hi. Right. Well, my advice is to keep this. I think that there's a lot of potential to overcomplicate this and spend a lot of time. As Harriet said, we're just going into too much detail. I think I've been doing this for 30 years and worked with a lot of companies, and usually the reason you share overheads, and I mean like things like if you're looking at all overheads, so think fixed stuff like the rent or the even the CEO's salary, or that kind of things that are not going to change whether you sell more software or hardware. It doesn't make a difference. It's there. To start splitting that out by product, to me it feels a bit of a waste of time and not very productive. I'm not sure how much value that's going to bring. Know your true gross profit of your products, absolutely. And if and if you do have, if it's highly people based, then that definitely, if you've got entire salaries with one type of product, then absolutely put that there, and allocate those by people. I think square footage and stuff. Like usually that's reserved for, you're sharing a space with another company, but it's all one company. I would kind of keep some of those fixed overheads kind of separate. But if you're really intent on doing that, then yeah, I think Samuel's explanations of those different methods are great to use. That's my advice.
Some very good points there, team. Thank you very much for that. Really appreciate it. Right here, we've got 23 minutes to go. So perhaps time for a few more questions. But I would like to encourage those of you that are here to, if you do have any questions, please don't feel shy. Just drop your question in the chat. There literally are no wrong questions and there's no need to be shy. Drop it in the chat. I'll give you the mic and then you can ask our team. I'm seeing some interesting comments about CT 600 and so on in the live streams on LinkedIn. And again, if I can tempt you to join us here in Microsoft Teams instead, it's really easy to do that. Simply just click on that Luma link that I've shared, or simply go to our website, startuptoscaleup.com. Scroll down a little bit, you'll find today's session, which is Startup Finances Q&A 09. Click join, quick registration on Luma, and now you'll find the link. And then come here and join us and ask your questions or add any comments or anything you would like to. But nevertheless, I'm going to read this question out loud for the live streams, and obviously the panelists here can read it themselves in the chat or refer to it rather. This is question 3 for today. So this is about integrating payroll and accounting systems for their compliance, or to be compliant rather. So the startup is a fintech startup providing budgeting tools for gig economy workers. They're currently in Norwich. The challenge they have basically is that the company's payroll system operates separately from its accounting software, leading to discrepancies in financial reports and delayed RTI submissions. So again, somebody will need to explain what RTI means to me, please. The situation basically is that they're pre-revenue funded by Innovate UK and some angel investment. Question: as a fintech startup managing payroll for a gig economy workforce, how can we integrate payroll and accounting systems to ensure accurate reporting and compliance with UK RTI and HMRC standards? What tools or processes, such as perhaps some API integrations or pre-built payroll modules, should we adopt to reconcile payroll data in real time and streamline tax submissions? I actually know a let's call it an accounting firm slash accounting software. I'm not going to mention their name, but really cool. And they've introduced AI agents for a lot of this kind of stuff. So, but anyway, let's hear from the specialists here what your views are, and if you can start by explaining to me what RTI is, please. I'd really appreciate it. I think I have an idea, but I'm pretty sure I might be wrong. So maybe on this, we can start with Sophie, Harriet, and last but not least, Samuel, please.
Hi. So from what I understand, RTI stands for real-time information, and it's something that it's like giving HMRC kind of the payroll data that they need for each payday. So it's interesting. Now, this is like you mentioned AI agents. I mean, there's an integration and automation is every week there's something new. And there's a lot of payroll providers out there, and hopefully, you know, they should do all the work. In terms of having that, I mean, if you have an external, sorry, sorry, I'm just thinking, are they looking to bring this in-house? Is that what they're looking to do? Yeah, I mean, if you do use an
I have
external
a
payroll,
feeling that
yeah.
they're already in the house. From
Oh,
what
they're
I can,
already in-house.
again,
Yeah.
again, this is why it annoys the living Jesus out of me when people can't be bothered to be here and send questions. But from looking at
Right.
the question, to me, it seems like it is in-house. They may use various
see.
software, but it looks like they're doing it all themselves. But
Yeah.
again, I might be wrong.
Okay. So yeah, I mean, I don't really know. I always outsource payroll because outsourcing payroll is cheap. And they know all the rules every time the rules change, and they, you know, they do all the work, and all they give you is, you know, they'll give you something you can just upload into your accounting system and it's done. So yeah, in terms of doing it in-house, the details for that, and I'm gonna pass on that one, I'm afraid.
No, that's totally fine. And by the way, I'm only making an assumption here. And maybe Harriet and then Samuel will probably be able to clarify this and understand it better than I do, whether my assumption is wrong here or not. But that's how I read it. Anyway, Harriet?
I would say, so I'm just picking up the piece that you said that the payroll software is separate from the accounting software. Now that in itself is quite normal, because let's just say an example, you use Xero accounting software for your business. The Xero payroll module, they have got one, but it's not brilliant if you've got a lot of staff. That's my personal opinion. Obviously, it does, you can process a lot of staff for it, but there's more specialist ones which are better for larger numbers of staff. That's quite a normal setup then to plug it into, you know, another system, and there shouldn't be a delay or a difference if it's sort of set up right, because you'll either have it in terms of the RTI submission, that is going from, it should be going from the payroll software, and that's linked to your HMRC account, so it should be going there, so there shouldn't be any delay. Getting into your accounting software so you can reconcile it, that should either be going through the API if it's connected that way, or whoever's doing it should be journaling in the payroll journal if they are manual. And obviously we talked about AI assistance and various things, but that there shouldn't be a significant delay in bringing all that data together, because certainly if you're doing monthly reporting, you're going to want to process payroll, make sure the data's in your figures for the month and be able to look at it. In terms of reconciling that, then that should be a case of as it happens, it reconciles. Obviously you've got to make sure you've got people coded where you want them, but the moment I'm not totally sure. I mean, I make sure, I suppose maybe the obvious one is that you are using a very legitimate payroll providing software that is compliant, and go into, you know, whoever's doing it, go into the HMRC side and check that the filings are coming through. If you've got concerns they're not getting processed, maybe you need to have a look, log into the account and see if they're there. If you're outsourcing it, then this should be something that, you know, if it's a reputable payroll provider, they should all be set up for you, and it should be functioning. I personally have had varying experiences with companies that outsource payroll, and sometimes you end up having to check it again and there might be mistakes, but it is something that obviously, you know, the big firms that do it regularly. It's often something that your accountant will maybe do for you as well if you're outsourced, but I think it's initially I would point you to what is the software you're using, and does it appear to be something that's, you know, compliant and reputable, etc. Who's in charge of the process, and do they understand payroll? Because as long as whoever's in charge of it is a professional in payroll, then they should be able to advise on all this and get it smooth and running effectively. So that's probably what I'd say. But I think there's possibly some bits of information we don't know about if you're doing it yourself, as in someone in the team is having a go, or if you have engaged a firm but you're not totally sure if things are happening right. So I think that's probably the big question as well, that, you know, we don't know the information on. So hopefully that's a bit of a steer anyway.
Thank you, Harriet. Last but not least, Samuel, please.
Yeah, I would pretty much say very similar to what Harriet said. It's very common to have a different accounting software to your payroll. We were working with a client just this week, and they have Bright Pay as a payroll, but they work from zero. I was a bit confused about when they said discrepancy in data. I wasn't too sure, but I'm guessing, on a pay slip, on a payroll, you may get gross pay, you may get pensions, you may get student loans, but in an accounting software, all of that may just come out as a salary, which probably can be broken down a little bit more into what they actually are in terms of pension contributions, student loans, and so on and so forth, right? I think you can work around these things easily. You can break it down if you want to. But I think that, yes, you can there's many softwares out there that incorporate both your accounting and software. Xero, for example, does it. Sage, I believe, do it as well, that incorporate it. But I don't really think you need to now think about getting the same software. There are ways that you can work around or managing this process as well. And I think as well, when the payroll may also be processed, let's say on the 28th of each month, but it might only be withdrawn from the company bank account on the 30th, right? So these some kind of timings and things like that. But I don't think it's a major issue at all. And I think there's many ways you can work around it. Have a conversation with your accountant if you think it's a concern, but I don't think it's a major issue.
Well, thank you very much for that, team. Really appreciate it. That's some brilliant stuff there. We've got 12 minutes to go. So I guess just a quick reset of the conversation. For those of you on the live streams, especially those that have just joined, this is Startup Finances Q&A. It's our 9th monthly session where we help UK startups with whatever questions they may have about your business finances. The questions are, or can be rather, shall I say, about anything to do with early stage finances, whether it's your cash flow or P&L, or perhaps projections / forecasting, maybe payroll, taxation, bookkeeping, VAT, auditing, tax credits. Not sure if I mentioned projections or forecasting, banking, fraud issues, and all that jazz, really. If you are on LinkedIn, YouTube, Facebook, or Instagram, and you want to ask questions, you'll need to switch and join us here on Microsoft Teams. It's audio only, which means you can tune in from anywhere via any platform or device. Either click on the links that I've shared on the live streams, or simply go to our website, startuptoscaleup.club. Again, it's startuptoscaleup.club. You click, scroll down a little bit, and then click join, where you'll go on to Luma for a quick registration, and then there you'll find today's link, and through that, basically join us here on Microsoft Teams. It's audio only. As soon as you join, just drop your question in the chat. We'll give you the mic, and then you can go ahead and introduce yourself and ask your question. If, though, your questions today are not on finances, please save them for the other conversations we run. We run 6 regular conversations, and they are on talent Mondays, product and tech Tuesdays, growth as in sales and marketing Wednesdays, fundraising as in investment and so on Thursdays, UK startup law on the 2nd Friday of each month, and UK startup finances on the 3rd Friday of each month, as you can see today. They're all from 12 to 1 p.m. UK time. They're all available on our site, startuptoscaleup.club. And you can also join our WhatsApp community. At the top and bottom of our website, you'll find a WhatsApp icon. If you click on that, you'll be able to join other founders and investors and operators, and of course our amazing panelists / mentors as well. I've also just dropped in the chat a link to a group that we've created specifically for the finances Q&A, and you can ask questions ahead of Q&As there. You can connect obviously with others. You can even discuss topics we touched on each Q&A and so on. Anyway, let's go on to question 4, which might end up being our last question for today. This is about structuring compensation for pre-revenue startups. They're a biotech startup trying to develop plant-based pharmaceuticals near Manchester. Challenge: the founders have no revenue and limited cash reserves, making it extremely difficult to decide on compensation without jeopardizing operational sustainability. The situation basically is that they're pre-revenue bootstrapped with some early stage angel funding. The question he has is, as a biotech startup with limited cash reserves, how can we structure founder compensation to maintain operational sustainability whilst ensuring personal financial viability? What UK-specific options, such as low base salaries supplemented by dividends or the use of directors' loans accounts, should we consider to optimize cash flow and minimize tax liabilities whilst adhering to HMRC guidelines? Now, before I pass you on to the experts, this is obviously only personal experience, but if you are a business that is later going to go out there and try and get VC money or other institutional investments, in my experience, they tend to frown upon director loans and sometimes even dividends. So do bear that in mind. Again, this is only my personal experience. Accountants and other finance people in general, in my experience, again, they love this kind of stuff, but just as a kind of caution, basically, that in my experience, VCs and other institutionals tend to frown upon you kind of getting into down the road of personal loans and director loans and dividends and so on. But anyway, let's hear from our amazing specialists. We'll start with Samuel, who will go on to Sophie, and last but not least, Harriet. What would you do here?
Oh, sorry. So in a situation like this, the goal is to strike a balance between the founder survival and company survival. And so in a situation like this, you want compensation that protects cash flow, but also keeps you compliant with HMRC rules, right? So the first thing I'll do, many of us have heard of this, start with a low, consistent salary. I mentioned in terms at the start of today's webinar about the do's and don'ts, and don't treat your company like your personal bank account. And so what you need is regular salary, not just picking at it when you want. Regular, small and consistent salary. Usually, what I recommend is between 8,000 and 12,000. That way you don't pay any income tax on any of the salary that you pay. So it's compliant. You get your pay slip.
That's per year, Samuel, right?
Sorry, say that again?
Or is that per year, annual, not monthly?
Yes, annual. Sorry, not a month. Absolutely not. Absolutely not. Right. So that's annually. So that's usually between like £700 and £1,000 a month for them. Also, we mentioned before, and I know it's something on this panel, and we discussed that we frown upon taking out dividends. Investors don't like it, but if you ever reach that point, only take it out when there are real profits, right? Not profits just on paper, but real profits that you can distribute small amounts. Because here we're talking specifically about survival. I will also be very careful about director's loan. Handle director's loan with care. We mentioned about taking money out of the business as a loan, and it must be repaid back within 9 months, or you face a 32.5% section 455. So it's an interest that you're going to have to end up paying under. Other things you can consider as well: grant funding and investor funding as well. Yeah, I mean, in short, I think the best model is a small, consistent salary for compliance, no dividends unless you actually have profit that exists. Yeah, those are my bit of advice for this individual here. But yes, the reality is that you're not to strike that balance in a situation where you are, where you're trying to start something, especially an innovative idea. You will constantly and most times be wrestling between your personal income and the cash flow of the business. It's one that just needs to be managed. But they are, especially as you're an innovative company as well, there are lots of funding out there that can assist you as well. I hope that helps. Thank you.
Thank you, Samuel. Ladies?
Hi. Yeah, I mean, I agree with everything Sam said. You know, I see a lot of founders take a 12 grand home, take advantage of the personal tax-free allowance and national insurance. Any other additional money they come in, you know, it comes out of directors' loans, but then, you know, it moves into dividends as long as you can take it out of profit. It is very risky if you're unsure that you're going to have profits. If you don't think you're going to be profitable, don't do it, and you'll be better off just relying on the salary that you've decided on and that you can afford. I mean, obviously you need, you know, see what you can afford. If there's absolutely no revenue, by the way, like, you know, yeah, it's going to be I mean, any of these kind of, no matter what you call it, whether it's dividends, different directors' loans, or what is it, salary, you still need the cash to be able to pay it. So, you know, just make sure you can afford to pay whatever you're paying. But yeah, I would, you know, if you're not profitable yet, stay clear of dividends and directors' loans, and just, you know, just pay yourself what you can, of what you can afford at a salary.
Pay yourself in IOUs. Thank you very much. And last but not least, Harriet, please.
So this is a conversation, I think that, yeah, it does, you know, happen a lot. And I think the first conversation to have, I don't know how many we are, but it's obviously multiple founders, is an open conversation together to understand, to be involved, and you may have already done this, I don't know, to be involved in this business. How much do you need to take? And it might be that some people have got other bits of work they do. I don't know if anyone else is consulting or in a job, or for whatever reason they've got their bills covered, and then somebody else might say, actually, no, I need to pay my mortgage, and I need to, you know, to be involved in this, I need to bring a salary of X. So you need to work out the minimum that you all need in the early stages to be in part of this. And for example, then we'd start to think about, okay, so maybe somebody needs some salary, but somebody else is actually fine, and they just want to make sure that, you know, they'll work for free effectively, but they, you know, might come into their share of the, you know, the share structure or whatever. That's important, because for the business to be viable, as you mentioned, you need to make sure that people are not going to default on their mortgage or whatever, and they can focus on this. But people may not have equal positions coming into this. Then I would look at, okay, you've mentioned you've got your pre-revenue, so there's no revenue coming in, but you've got some reserves, which I presume means you've either put money in yourselves, you've got a loan, you've otherwise come by some money to start this off, or perhaps I've missed something. Is there anything else? No, I think there's nothing that says exactly where it's from. That is really precious, because you can use that in lots of different ways. And I would be starting to model, okay, if we were to put in these proposed salaries, how much money do we have? How long is it going to last? Is that then meaning we can get on and focus on building the business because we don't have to worry about money? Great, that's a good use of the money. You need to work out how long it's going to last you for, and what else you need to spend money on. And then that may be a trade-off to say, well, actually, if we pay ourselves, we can't pay for whatever other costs we need to do to invest in it. I'd also look at when you're likely to go revenue, because, you know, to start generating revenue, because that's going to make a big difference then, because once you're generating revenue, perhaps that changes things. But I think the main thing is to have the conversation, document it, and note the differences in your own personal financial situations that may exist and how you're going to manage it in a fair way that means that you can keep going, but also being mindful that actually the business may not be able to pay you yet. I think that's all I've got to say for now, conscious of time as well.
Geez, we're on fire today. Take that, financial confusion. Thank you very much, team. I really appreciate your time and your absolute gems that you drop. 2 minutes over the line. So if you have time, I would love to hear some parting words. If not, I totally understand. Maybe we can start with the ladies of the house first. So perhaps Sophie, then Harriet, and then Samuel, if you've got any parting words.
Hi, yeah. So my parting words are, have some kind of finance function from day one, and that doesn't mean hire someone or, you know, have a full department. Even if you're doing it yourself, just make sure you start to, you know, get a system, keep your records in order, you know what's happening in your bank account, reconcile your bank account, do all of that from the beginning. Because some people wait, or they'll register for VAT and do 3 months of bookkeeping the day before the VAT's due, or they'll do, so I've seen 6 months ago, okay, I started ages ago, and oh, now I don't have any records, and you have to do 6 months of, it's a nightmare. You'll be so much more in control of your business if you just start actively facing your finances from day one.
I would just add, sometimes we think it's a tick list, do my cash flow, do my budget, do my forecast, etc. I'd invite you to keep things as iterative documents. So if you've got a cash flow document, make that a habit. You need to be updating things. In startups, things change very quickly. The things you thought a couple of months ago are not the case now. So make sure your financial, reports, cash flow, assumptions, budgets, all of the different things are live documents that you regularly go into, because otherwise they're very quickly out of date. And these are things, particularly a cash flow forecast, that is going to give you sanity. So you want to make sure you're on top of that. So yeah, otherwise, thank you for having me again, and always happy to connect on LinkedIn and follow up on any questions.
Thank you. Last but not least, Samuel, please. Looks like Samuel left, probably. Samuel, you're still here? Right, that's okay. Let me see. Yep, Samuel's left, not a problem. Well, thank you very much, everyone, for tuning in today. Really appreciate your time, but I especially appreciate our panelists who took time out of their busy days to come and help us for free today for an hour. Couple of quick things before my parting words. Just number one, we run 6 regular sessions helping startups hopefully go from startup to scale up, or helping founders rather. On Mondays, we take questions on talent, so hiring and keeping the right people. On Tuesdays, it's product and tech, so how to build your early stage. On Wednesdays, it's growth, so how to go to market and sell, basically. On Thursdays, it's fundraising, so how to raise investment or grants or whatever it may be. And on the second Friday of each month, it's UK startup law, so how to protect and defend your business. And then on the third Friday of each month, as you can see today, it's UK startup finances, so how to make sense of your numbers and basically, hopefully, help you successfully manage your startup finances. They're all from 12 to 1 p.m. UK time. They're all available on our website, startuptoscaleup.club. Again, startuptoscaleup.club, and you can RSVP to future sessions that you prefer. When you're on our site, you may also want to join our WhatsApp community. We've got some amazing groups of founders, investors, operators, of course, our brilliant panelists and mentors as well. And yeah, that's in a nutshell. The second part is for those of you on the live streams, please do join us here on Microsoft Teams next time. And if you've got questions, rather than default to sending them because you might feel shy, or you think people will think differently of you, or you think people will want to steal ideas from you, none of that is going to happen. But one thing that is guaranteed to happen is that you'll get better answers from our amazing panelists. And let's be honest, it makes for a more interactive and better conversations anyway. So please feel free to join us here in Microsoft Teams. It's audio only, which means you can tune in from anywhere via any platform or device. And it doesn't matter whether you're walking your dog in Surrey, or perhaps cooking or eating lunch in Liverpool, or maybe changing baby nappies in Glasgow, or working from a shared office in Cambridge. It really doesn't matter where you are, you can easily tune in. Now, as far as my parting words are concerned, just remember the startup journey can be both exciting but also quite challenging. So try to have some fun in the meantime, and be kind to yourself and everyone else for that matter too. Otherwise, have an amazing weekend, and hopefully you'll join us on Monday for Startup Talent Q&A at 12 o'clock. Thank you, and God bless. Bye-bye for now.